Most people in this country believe that sending money to a relative is nobody's business but their own. A birthday check for your nephew, tuition help for your niece, a down payment gift for your kid's first house. Something personal, something private, something that stays between family members. And honestly, for decades, that belief was mostly correct. The IRS simply did not have the technology to track money moving between relatives unless you were already under audit and some agent happened to dig through your files. Those days are completely over. By 2026, the IRS is running 129 artificial intelligence programs, more than double the 54 they had just 2 years earlier. These systems pull information from every bank in America, every digital payment app, every brokerage account, every mortgage lender, and every state tax agency. They never sleep, they do not care about weekends or holidays. Their entire purpose is to spot transfers that should be classified as gifts, that should create a tax bill, or that at the very least need an explanation. If you have been handing money to family members thinking nobody was watching, somebody is watching now, very closely. Here is what most people do not realize. The IRS is not using one AI tool, it is using 4, and each one targets a completely different type of taxpayer. The first and oldest is called the Discriminant Function System, DIF for short. It has been around since the 1960s, but today's version is unrecognizable compared to the original. It scans every single tax return filed in America and compares your numbers against statistical profiles built for people who match your age, income, zip code, and occupation. If your deductions jump unexpectedly, if your bank deposits do not match what you reported earning, or if you keep reporting round numbers instead of exact figures, DIF flags you, not to a person. To another algorithm, the second system is called the individual taxpayer model, and it is far more powerful and far more dangerous. Instead of looking at just 1 year, it reviews your entire filing history. 5 years, 10 years, even 20 years if your records go back that far. And it does not just flag potential issues. It identifies the exact 3-line items on your return that are most statistically likely to trigger a tax adjustment if a human agent ever opens your file. What that means in real terms is this. Before any audit even begins, the IRS already knows what it expects to find. The agent has not even seen your name yet. The third system is the Line Anomaly Recommender. This one is brand new. It replaced the old method the IRS used to pick corporate returns for audit, and now it focuses on wealthy individuals who report business income, partnership distributions, or real estate holdings. Instead of checking one line at a time, it analyzes the mathematical relationship between every single line on your return simultaneously. If your depreciation numbers do not match your asset pool, or your partnership distributions do not line up with your capital account, it catches it instantly. The fourth and most aggressive system is the Large Partnership Compliance Model. Before 2021, the IRS flagged maybe a handful of large partnership returns per year for audit, single digits. After this system went live, that number shot up to 82 flagged returns in one single year, somewhere between 10 and 100 times the previous rate. If your family uses any kind of limited partnership, family trust, or pass-through entity to hold assets, this system is watching you. All 4 systems pull from the same massive data pool. The IRS calls it the Compliance Data Warehouse. It contains every deposit you have ever made, every W-2 your employer ever filed, every 1099 with your name on it, every payment app transaction reported to the government, and every suspicious activity report any bank has ever filed about your accounts. No warrant needed, no notice required. The IRS does not have to tell you they have any of this. They just do. Let me show you exactly how families get caught. Imagine you have been sending your adult son money. 10,000 here, 15,000 there, spread over 3 years. Some in cash, some through Zelle, some through Venmo in round amounts. It all felt private. Then 6 months later, he walks into a dealership and puts 70,000 down on a truck. The dealership files Form 8300 with the IRS. That is the form for large cash transactions. The title company sends loan data to credit bureaus, which the IRS also pulls from. Then your son files his tax return, showing 42,000 in income. The AI sees it immediately. 42,000 earned, 70,000 spent on a down payment, no inheritance on record. That is what the system calls a lifestyle-to-income mismatch, and it gets flagged automatically. From there, the system traces backward through his banking records, looking for where that money came from. And that is exactly when your old Venmo transfers light up. The algorithm's pattern detection. The system does not care that you love your son. It only cares about the pattern. Once it finds one, your file goes into a review queue. By the time a human agent looks at it, your entire 3-year transfer history is already laid out in a clean timeline on their screen, before they have read a single word of context. Now let me get specific about family gift transfers. The annual gift tax exclusion for 2026 is $19,000 per person. That means you can give up to $19,000 to anyone, a child, a grandchild, a niece, a close friend, in 1 calendar year, with 0 tax and 0 paperwork. Married couples can combine their exclusions through gift splitting on Form 709, which doubles it to $38,000 per recipient per year. Send your son $38,000 this December. Clean. Send it again next January. Still clean. But the second you go over the limit by even $1, everything changes. You must file Form 709. And here is what most Americans never find out until it is too late. Form 709 is not just a reporting form. It opens a 3-year window during which the IRS can audit and challenge that gift. File it correctly with full details, and after 3 years they are legally blocked from touching it. That is the good news. The bad news is this: if your Form 709 has what the IRS calls inadequate disclosure, that 3-year window never starts. Not 3 years, not 10 years, never. The IRS can come back 20 years from now, 40 years from now, after you are gone, after the recipient is gone, and demand full payment, plus penalties, plus all the interest that has compounded. And what counts as inadequate disclosure? Writing gift to nephew instead of gift of $18,500 in cash to John Doe, SSN ending in 4877. That is inadequate. Not including the fair market value of what you gave on the exact date you gave it, inadequate. Not describing the asset well enough for an appraiser to verify it, inadequate. Most people who fill out their own 709 do it inadequately, and the IRS has zero obligation to tell them. In fact, the IRS has every reason not to tell you, because as long as your disclosure is incomplete, they keep the door open forever. Potentially decades from now, when you have forgotten about the transfer and your records are long gone, they can hit you or your estate with the maximum tax, penalties, and compounded interest. This is not some rare edge case. It is the single most common gift tax trap in the entire tax code. And it hits families giving modest amounts just as hard, because a small gift filed wrong has no statute of limitations at all. The lifetime gift and estate exemption for 26 is $15 million per person. That number came from the One Big Beautiful Bill Act passed at the end of 2025. In practical terms, as long as your total lifetime gifts stay under $15 million, you owe zero actual gift tax when you file Form 709. But you still have to file it. And you still have to disclose everything accurately, or the IRS keeps permanent authority over that gift. The widespread belief that a zero-tax filing does not need careful reporting has cost American families millions in back taxes and penalties over just the last 10 years. Now let me cover what is genuinely new in 2026. How the IRS watches your digital payment activity. This is the first year the 1099K reporting threshold is finally locked in after years of delays and reversals. Here is the rule: payment apps must send both you and the IRS a 1099K only if you receive more than $20,000 in a calendar year through more than 200 separate transactions that are categorized as payments for goods or services. Both conditions must be met at the same time. One without the other does not trigger reporting. This is the rule under the One Big Beautiful Bill Act, and it is here to stay. Venmo, PayPal, and Cash App all follow this standard. Personal transfers between family or friends marked as not for goods or services are not reported. Spousal transfers are not reported. Zelle does not issue any reports at all because Zelle never actually holds your money. It just moves it between existing bank accounts. Because of that, a lot of people have decided Zelle is invisible to the IRS. That assumption is dangerously wrong. Your bank sees every Zelle transaction that flows through your account, and your bank is legally required to report suspicious patterns to FinCEN, the Financial Crimes Enforcement Network. FinCEN shares everything it collects with the IRS. So if you send your daughter $15,000 a month through Zelle in a steady pattern and she uses it for rent, probably no flag. But if you send her $30,000 in one day, then $10,000 the next week, then $5,000 3 days after that, your bank will almost certainly file a suspicious activity report, and you will never know it happened. The law that requires this reporting is Title 31 of the U.S. Code, Section 53318. Banks are expressly forbidden from telling customers they filed a report. You will only find out if and when the IRS shows up with questions. There is one more bank reporting rule every family needs to know. It is called a currency transaction report, and it triggers automatically every time you deposit or withdraw more than $10,000 in cash. The bank has no choice. It does not matter if the money is yours. It does not matter if the withdrawal is for a perfectly normal purchase. The bank files a FinCEN Form 104 every single time. The IRS accesses this database through the Bank Secrecy Act search tool. They can query it without a warrant, without telling you, and without even telling their own bosses they looked. Now I need to stop here and talk about something most Americans have never heard of, because it is the single most financially destructive thing families do over and over. It is the joint bank account. Most parents, when their kids grow up, think it makes sense and feels loving to just add the child's name to their checking account. That way the kid can help pay bills if the parent gets sick. It seems reasonable. It feels like trust. It is actually one of the most legally dangerous moves you can make under American tax law. The moment you add an adult child's name to your account, the IRS can argue that a portion of every dollar in that account was gifted to the child on the day their name went on. The IRS does not always pursue this, but if you ever need to prove no gift happened, during an audit, during probate, after a death, during a family dispute, or in a divorce, the burden is 100% on you, and the paper trail never goes away. Every deposit into that account is now partially the child's. Every withdrawal the child makes gets scrutinized. If your kid takes $10,000 from the joint account for a car repair, the IRS can treat that as either a gift from you or an advance on your estate. Either way, the tax mess is real and potentially very expensive. The second trap involves the difference between inherited property and gifted property. And most families walk right into it without knowing. Here is how it works. If your mum gives you her house while she is alive, you get her original purchase price as your cost basis. If she bought it in 1985 for $60,000, your basis is $60,000. When you sell for $600,000, you owe capital gains tax on the full $540,000 difference. At the 20% long-term rate, plus state taxes, plus the 3.8% net investment income tax, your bill can top $130,000. But if your mum keeps the house and leaves it to you through her estate after she passes, you get a stepped-up basis. Your cost basis resets to the fair market value on the day she died. $600,000 in this example. You sell the next day for $600,000. Your gain is zero. Your tax is zero. Families hand over homes to their kids all the time thinking they are being generous and maybe reducing estate taxes. What they are actually handing over is a six-figure tax bill that the IRS will collect the moment the kid sells. Every family thinking about transferring real estate needs to understand this deeply. A lifetime gift carries the old basis forward and creates taxable gain. An inheritance triggers the stepped-up basis and creates zero gain. If you can afford to hold the asset until death, that is almost always the smarter move. And starting in April 2025, surveillance got even tighter in certain areas. FinCEN issued a geographic targeting order that dropped the cash reporting threshold for money services businesses near the southwest border from $10,000 down to just $200. That order ran through September 2025. Similar orders have been issued and extended in other regions since. If you live near a target zone and walk into a Western Union carrying $300 in cash, you are now in the FinCEN database permanently. So what does all of this mean for a normal family just trying to help each other out? The most important thing to accept is that ignoring these rules is not an option anymore. The IRS had about 102,000 employees at the start of 2025. By December, that number dropped to $74,000, a 27% cut in human staff in under a year. And instead of pulling back on enforcement, they did the opposite. They massively expanded their AI systems. The agency now enforces with laser precision. Fewer audits overall, but the ones they open are picked by algorithms that already know exactly what they are looking for. The base audit rate on gift tax returns has historically been around 1% and is still there. That sounds fine until you see that the audit rate for estates over $10 million is 22. Roughly 1 in 5, and the audit rate on returns flagged for inadequate disclosure is even higher, because those returns have no statute of limitations. The IRS can let those files sit for decades and pull them up whenever they want. When resources open up, when budgets allow, or when a new analyst runs fresh queries against the database. Here is the good news. There are 5 legal strategies that families use every single day to stay completely clear of all this surveillance. Strategy 1 is gift splitting. If you are married, you and your spouse can each give the full annual exclusion to the same person in the same year. That means a couple can legally transfer $38,000 per recipient annually with zero tax and zero filing. A couple with 4 adult kids can move $152,000 a year into the family, completely invisible to the IRS. Strategy 2 is the direct payment exception, and it is far more powerful than most people realize. When you pay tuition directly to a school or medical bills directly to a hospital on someone else's behalf, the IRS does not count that as a gift at all. Not partially, completely. You can write a $100,000 check straight to your grandkids' university this year, and not a penny of it touches your exclusion or your lifetime limit. It is entirely outside gift tax rules. The only rule, the payment goes straight to the institution, not through the family member first. If the money hits your grandkid's bank account before the school, it is a gift. If the check is made out to the university, it is not. Strategy 3 is the 5-year election for 529 college savings plans. A 529 is a tax-advantaged education account, and the tax code lets you treat one large contribution as if it were spread evenly over 5 years. So in 2026, you can put $95,000 into one person's 529 in a single year, file a 709 with the 5-year election, and the IRS treats it as $19,000 per year for 5 years, fully within the annual exclusion every single year, completely legal, and no extra filings needed for the next 4 years. The money grows tax-free inside the account and comes out tax-free for qualifying education costs. It never shows up as a taxable gift later. Strategy 4 is the Crummy Trust, named after a 1968 court case, not because it is bad, but because it works. A crummy trust lets you put assets into an irrevocable trust for a beneficiary. As long as that beneficiary gets a short window each year, usually 30 days, where they can pull the money out, the contribution counts as a present interest gift and qualifies for the annual exclusion. This is how wealthy families move tens of millions across generations without ever triggering a taxable gift. You fund the trust with $19,000 per beneficiary yearly. The beneficiary gets notice they can withdraw it within 30 days. They choose not to. The money stays in the trust. You repeat this for 30 years. You have now legally moved $570,000 per beneficiary with zero gift tax. Multiply that across multiple beneficiaries and multiple generations, and you see how serious family wealth moves quietly, year after year. Strategy 5 is spousal transfers. Federal tax law treats husband and wife as one economic unit for gift tax purposes. You can move unlimited money, property, investments, anything to your spouse, and none of it is a gift. None of it is reportable. None of it uses up any exemption. Spouses are basically invisible under the gift tax rules. Why this matters in practice, many families use it as a rebalancing tool. If one spouse holds an asset meant for the kids, they transfer it to the other spouse first, and then that spouse gifts it to the children. That activates a brand new annual exclusion and a brand new lifetime exemption, effectively doubling the household's tax-free transfer power every single year. Now here is what I think is the most critical point in this entire discussion. The IRS AI systems cannot read your intentions. They do not know you love your family. They cannot tell the difference between a wedding gift, a graduation check, and emergency medical help. All they see is whether the patterns match what their training data says is normal. If a parent sends $19,000 to each adult child every year in a predictable pattern, the algorithm sees nothing. But if a parent sends $18,999, the algorithm flags that exact number as suspicious, because that pattern matches someone deliberately staying just under a reporting threshold, and that is a federal crime under Title 31 of the U.S. Code. It is called structuring. The IRS does not need to prove you meant to stay under the limit. They just need to show the pattern exists. So here is what you actually need to do if you want to support your family without becoming a flagged target. First, stop thinking about how much you are allowed to give, and start thinking about what you can prove clearly. Every transfer needs a clear note saying what it is for. Every transaction needs a documented reason. Every gift over the annual exclusion needs a properly filled out Form 709 with full, specific disclosure. Second, use the tools the tax code already gives you. The direct payment exception, the 5 from 29 5-year election, the crummy trust, gift splitting. These are not loopholes, these are not grey areas. These are the actual rules written into the law. Wealthy families have used them for generations. Middle-class families have paid taxes they never should have, simply because nobody ever told them these options existed. Third, accept that IRS AI is only going to get bigger and more aggressive. The agency is cutting human staff, but pouring money into computing power and data processing. Next year, there will probably be fewer audits, but the ones that happen will be chosen by systems that already mapped where the money went, who sent it, and exactly why it is taxable. You do not want your name in that queue when the next algorithm runs. And finally, every financial transfer you make in 2026 is a permanent digital record. Your bank has it, the payment app has it, FinCEN has it. The IRS can pull it without asking you. For the first time in American history, the federal government has the technical ability to monitor every single person's financial activity in real time. Not just during audits, not selectively, but continuously and automatically, and they are using that ability right now. Let me close with a real case that is playing out in tax courts across the country right now. A grandmother in Pennsylvania sent $90,000 to her grandson over 4 years to help him finish medical school. She did not know about the annual gift exclusion. She never filed a Form 709. She wrote checks directly to him because she loved him, trusted him completely, and wanted him to have the career he worked for. 3 years after the last check, her accountant filed her tax return. The IRS algorithm spotted a pattern, not in the return itself, but in her bank records. Large outflows from her account that did not match her income. Deposits into his account that did not match his earnings. 2 years passed while the case moved through the IRS pipeline. By the time it was resolved, the grandmother had died. Her son, acting as executor, received a bill for $72,000 in back gift taxes, penalties, and compounded interest. If those same gifts had been reported on properly filed Form 709s with complete disclosure, the total tax owed would have been exactly zero, because the total was well within her lifetime exemption. The only thing missing was the paperwork. That is how families lose real money, not through some fancy tax scheme, but through a simple lack of knowledge about what the algorithm is built to detect. The families that will be fine in this new world are the ones who learn the rules, file their 709s with full and accurate disclosure, use the legal exceptions that exist for exactly this purpose, and treat every transfer as if it is being watched. Because starting this year, every transfer is being watched. You cannot hide from the algorithm, but you can use the rules in a way that gives it nothing to find. The tax code was not built to punish families who love each other. It was built to reward families who plan. The 129 AI programs inside the IRS are not there to catch parents helping their kids. They are there to catch people who think they are above the rules. If you know the rules and follow them correctly, Falfalvo, you are not in the database as a target. You are in the database as someone who did everything right. And that difference in a year when the IRS has more computing power than ever in its history, and fewer human agents than any year this century, is the difference between protecting your family's financial future and quietly handing a huge chunk of it to the government for no reason other than not knowing what the rules actually said.